Okay. I believe we are live. Hi, everyone. Good afternoon. Thank you for joining me. My name is Joanne Theriault-Fazio. I am the Divisional Sales Director for Origin Point here in the Midwest, and one half of the Theriault-Fazio team, a husband and wife team out of Origin Point. Happy to bring everyone together today for the Homebuyer Series webinar. We are going to be talking about perfecting your credit and credit repair. And with me today, I have Devin Norcross. He's the owner of Norcross Consulting Services. I don't even know how long it's been. I think it's probably been at least a decade that I've been working with Devin, where he's helped a lot of our clients. Sometimes it's just getting maybe 20 points in their credit score, and sometimes it might be getting 100 points so that they can even purchase a home. I don't want to say he's a miracle worker, but sometimes he's actually been a miracle worker, removing mortgage late payments and all of these interesting things. And he's going to go over a bunch of information related to credit. And we will have a handout that we'll be able to email off to you later on. And you can always revert back to this video if you'd like to, or forward it to friends and family. It will be on the YouTube channel. But I want Devin to go ahead and introduce himself a little bit. He's going to talk about so many great things that he does for his clients and helping them, just get to that next level with credit, or just getting to a point where they can purchase the home. So Devin, I'm going to go ahead and turn it over to you.
Thank you. Thank you so much. Well, I appreciate the invitation. I love speaking to all types of groups. I do have many different PowerPoints and many different slides. I want to keep this really angled towards our first-time home buyers. But if anyone wants to know more in depth about any particular area of something I touch on, if you want to know more in depth about specific scoring models, or best advice on buying a car, how to get high limit credit cards or companion passes with Southwest, I've got lots of fun tips and tricks on how to work the system there. So what I'm going to do is I'm going to go ahead and I'm going to go ahead and share my screen and start a slideshow. Sorry, I mostly use Zoom. Just takes me a second. And we're just on the wrong screens here. Hold on one second. I use a 3-monitor setup, so it's just going to take me a second here. Apologize. Keeps kicking me onto the wrong side here. There we go. Okay, do we have a full screen, Joanne?
Yes, I can see the little, Equifax TransUnion Experian. Now I can see your main slide, the first page. Yep.
Wonderful. Okay. All right. Sorry for that delay. The troubles with running 3 monitors. So a little background. I've been doing this 19 years. My sole purpose in life is to help people get into home loans. Where there's debt settlement, whether it's consultations, whether it's connecting them with the right people. My goal here is to be your intermediary and help you understand how to maximize your credit scores. Sometimes that comes into automotive refinance. Sometimes it comes into consolidation loans. There's all kinds of things we look at. One of the things Joanne mentioned is she likes kind of when I post results, and some of these are just some recent client results. These are going to be 30-day imports. All right. Now, not everyone's going to see imports like this, but we have 131 points in 30 days. We have 103 points in 30 days, 90, 68, 111, 127. That's what's possible. Now, it doesn't mean that every client's going to see those results. Really, largely, if we average 1,000 clients, we're going to see something more closely to like 20 points a month. But the clients that come to me that have a will and they have a way and they stick to the plan, and they follow my plan, some of those results are possible for you as well. So the first thing I want to do is explain a little bit about the credit bureaus. So the credit bureaus are very old companies. They're very large companies. Equifax has been open since 1899. They're also client industries that they're not infallible. They have a lot of data breaches. One of the reasons my industry exists, the Fair Credit Reporting Act exists, the ability to contest items on your credit report, is that we do see a lot of errors on credit reports. We see merged socials, we see inaccurate balances, inaccurate credit limits, we see accounts with late payments after they've been paid off or closed or refinanced. So what they are is a data collection firm, and they house your data like a filing cabinet. And what they are not is that they're not scoring agencies. They're not someone that makes a decision about you and the likelihood of you paying off a loan or creating an algorithm about your credit history. TransUnion here, also very old, 1968, has 13,500 employees, roughly, operates in 30 countries. Experience roots go back 180 years. So Experience huge, operates in 30 countries. But again, what they are is data collection firms. In fact, the Fair Credit Reporting Act, which allows us to contest and dispute negative accounts, was created in 1978 because Equifax was paying its employees to dig up negative information on individuals and not positive information. So, how do we get a credit score? That's kind of what is the answer that I want to answer initially for people, because people go to all different places to see their credit score. They go to Credit Karma, they go to Privacy Guard, they go to their lender, they log into Capital One, and in all those credit cards, all the scores you see are accurate. They are scores, but they might not be the scores for what you're trying to do. In this case, we're trying to become homeowners. We want to work with specific scores. So, what's the flow of information on how we get to a credit score? So, as an individual, you apply for credit card, a home loan, you apply for something, you apply with a lending institution. Okay. That lending institution is going to take request your credit data from the credit bureaus. And then they're going to pair that data with what we call a scoring agency. A scoring agency, Fair Isaac or FICO being the largest. Another one is starting to be a much bigger player on the scene is called Vantage Score. They're two competing companies. They both create mathematical models that help you understand what your credit score and loan worthiness is. And then they're going to bring that information back to the lender and let you know what your credit score is and what your credit history is. Your credit history is what we call a data packet. Now, let's say you move forward and open up a mortgage loan. You're going to make payments to that institution. And then they're going to report those payments, not because they have to, but because it's in their best interest to the credit bureaus. So the lending institutions actually pay money to do that. The larger the institution, the less they pay. A lender can also request a data packet without credit scores. This is something that's usually done once you're pre-approved, once your loan's gone through. Right before you close, they might want to say, let me make sure that you're not buying two houses at the same time. Let me make sure that you didn't go buy a $100,000 truck. So they might request a new data packet on you, which is just the credit bureau data, not necessarily a score. They have your scores, they're comfortable with your scores. And in few and rare occasions, they might see something that's worrisome on that data packet. And in that scenario, they might then want to go see what the newer credit scores are. The FICO scoring model, FICO is just a short-term acronym for Fair Isaac Corporation. All right. And they have many different models, 50, 60 different models. Every few years they come out with a new one. Sometimes that new model is accepted into a varying industry. When I go to Capital One, when I go to Rocket Money, when I go to my bank account, I get a FICO score. It's called a FICO 08. That's not my credit score for a mortgage loan. That's not my credit score for an auto loan. It's not my credit score for my insurance. What you see here is a screen grab from a website called MyFICO. MyFICO is Fair Isaac's own website. You can go to MyFICO, pay $39, and get your own mortgage FICO credit scores. It's what I personally pay for. It's kind of the gold standard in credit monitoring. But you got to come down here where it says mortgages. You click on that and you can see what your actual mortgage scores are. Very importantly, it's going to be a soft pull. There's no negative impact. We will touch on there between a soft pull and a hard pull. Joanne and her team at Origin Point and all the related companies, they can do soft pulls. So it's not like the old days where if you have a lender look at your credit, you're guaranteed to get a credit inquiry. But if you're not trying to buy something or you think you might want to buy something down the road, MyFICO is a tremendous resource to check, especially maybe you're going to buy a car, right? I might want to come through MyFICO and see, okay, my TransUnion over here on the left, my auto scores are in the 660s. but I've got a 706 on my Experian and a 700 on my Equifax. Well, I'm going to call around and find a credit union that'll use Experian or Equifax. A lot of credit unions only use one bureau for auto lending. So I want to make sure if I'm going to buy a car, I'm going to get pre-approved, I'm using the bureau that has the highest automotive FICO score. A couple other things to note in this, and it might be hard to see, but the ranges change. So this is 300 to 850. This one's 250 to 900. You might see an 860 credit score that's not physically possible in the mortgage space. And it's important to know you can have, on this scenario, we've got an 80-point spread on the same bureau, just depending on which algorithm is being used. Mortgage algorithms are a little bit more stringent. We find that mortgage scores sometimes are the lowest scores of all the FICO scores outside of maybe auto because they're in a higher range because it's a very expensive product and we want to be very particular about who we get approved. So what do we know about the FICO scoring model? So on the mortgage space, there's 5 components that make up the FICO scoring model. The first is payment history. Now, this is where 2 things are it's really built upon on 2 areas. One is negative information. What are your collections like? What are your charge-offs like? What are your late payments like? And how long ago did those happen? It's not how large are they, it's how long ago did they happen. The more recent they are, the more negative they impact you. So a $100 collection from 4 months ago versus a $10,000 collection from 4 years ago, the $100 collection is impacting you much, much more than the $10,000 collection. Now, the positive component to payment history comes to something called months reviewed. It's a column we see on a mortgage lender credit report. You probably aren't going to see it on your credit report at a consumer site. And that's like how many payments have you made while an account's been open and active. Unfortunately, FICO does not give you positive points for closed accounts. So we're looking at open and active accounts. A 10-year-old mortgage is going to have 120 months reviewed payments. A 10-year-old student loan that was in deferment for 7 years isn't going to have 120 payments in the months reviewed. Now, the fact that they're both 10 years old does impact. It comes down here in what we call length of credit history, but it's not payment history. So the amount of payments you make, and then there's the amount of time you've had your accounts open and active. They factor into 2 different categories. Remember, with the FICO scoring model, it forces you to borrow. So it does not give you positive points for closed accounts, accounts in deferment or forbearance. Doesn't give you points for, again, accounts that have been refinanced. Those old payments, you lose those payments. The next largest component is amounts owed. This is exclusively revolving accounts. So what is your balance to credit limit ratio? And it splits it up equally per card. So if 30% of your score is based off of a per card basis, the last client I spoke with, she has 1 credit card. It only has a $100 limit. She has a $70 balance. So as her balance goes from $10 to $70, it's going to have a huge impact. It's impacting 30% of your score. If she had 2 credit cards, they'll each be worth 15%. If she had 3 credit cards, they're each worth 10%. So it doesn't factor in your total balance and your total credit limit to look at that utilization. It factors in on a per card basis. Now, I'm going to skip this. I'm going to come back to this slide in a second. How are you penalized as you use your credit card? Let's use that client with a $100 credit limit. So if she uses her balance up to, say, $50, she's on the exponential scale. She's going to be losing about 30% of the points available to that card. Up around 75% or $75, she's going to be losing about 90% of the points available to that card. So we always talk about 30% being a sweet spot. The ideal situation is you have a little bit of balance on at least 1 card, recent activity on all cards, I say within the last 6 to 12 months. And then the card that you do have a balance on, you're keeping that balance for sure under 50%, closer to 30 is best. Now, sometimes it's hard to do that. So you want to know when to do it. So if we look at the calendar as a linear month, we have the first of the month to the 30th. This is a Capital One card. It's my personal Capital One card. It's due on the 24th, but it reports on the 17th. So if I want to maximize my credit score, I want to pay my card down on the 16th. Now, whatever balance I carry into the 24th, I'm going to pay interest on. So what's best for your credit and what's best for you financially are often 2 different things. But if you want to maximize your credit score, we're more focused on the reporting date, and you can always find the reporting date out by calling the creditor. Um, I've never not been able to find out. If you believe you're speaking to an overseas call center, sometimes asking to be transferred to a US-based call center is the best way to find that. Another thing we look at is credit mix. About 10% of your score is based off the percentage of revolving versus installment. We don't really want to see more than a 1-to-3 ratio. So if you have 2 credit cards and 6 car loans, or 2 car loans and 6 credit cards, great. If you have 1 car loan and 12 credit cards, we're going to suggest paying off and closing some of those cards. And what we're going to be looking for is we're going to be looking at the smallest cards, and more specifically, the youngest cards. When we close young cards, we increase our average length history. So that's where we talk about length of credit history. Again, 15% of your scores is the average time frame you've had your accounts open and active. This is an area to improve points that is largely overlooked by most people. There's 4 ways that we go over with our clients to improve their average length history. The first one is to get added as an authorized user. We call this piggybacking. I love it. I use it all the time. I even have cards available for some of my clients if they need it. But if you get added to an 18-year-old credit card as an authorized user and you're 18 years old, your credit's going to reflect like you've had that credit card for 18 years. You're also not legally responsible for that debt. If someone increases the debt, their balance, you can be removed. They get a late payment, you can be removed. If you go to buy a home loan, the team at Origin Point is not going to calculate that debt against you, but it's a fantastic way to increase your average history. Now, if we're going to add an old account to increase an average, the opposite of that would be to closing young accounts. This is another great tool, great tactic I use all the time to improve credit scores, and that's to close recently opened accounts. I've seen over 60 points on the right file by doing this. A third tactic is to take a student loan out of deferment. If you don't have a lot of credit history, what you do have that's old is student loans that are in deferment. You could take a small old student loan out of deferment and start making payments on it. And while you're not going to generate payment history, because you now have an active loan again, you are going to generate a lot of length history. Again, 40 to 60 points on the right file is not unheard of for doing this. And the final one is to get activity on inactive trade lines. If you're like me, you probably have cards with creditors you may never shop at again. Mine's Express. I'll probably never shop at Express again. I don't travel for sales anymore. H&M is a third of the price. Every year, though, I go into Express. I go to the checkout line. I pick up something on the way. I give them my driver's license. I punch my social into the keypad, and I'm able to buy something using my Express card. And then what I do is if there's not a big line behind me, I just ask to return that item. And what I've done is I've sent a digital ping to Community Bank not to close my account. It's still in use. What you don't want to do is have your old cards closed because you're not using them. Care credit cards for dental work, jewelry cards, K's Jewelers for engagement rings, things like this are things I see a lot. And then about 10% is allocated to new trade lines. New accounts are a penalty. The only time your score goes up when you open a new account is when you open your first account or your first revolving account. Outside of that, you're always going to see a drop when you open a new account. And if you do start getting a lot of hard pulls, they are going to start impacting your credit. For most people, it's about a point or two for the first 6 months. Then after that, it's probably even less. After about a year old, they really don't impact you at all. I have seen clients with 101 inquiries in 90 days. You can lose about 40 points in inquiries according to the algorithm. So if you have a lot of inquiries, it's something to be very mindful of. Don't be afraid to let a lender pull your credit. Be afraid to let a lot of lenders pull your credit, or an auto lender, what we call shotgun blast your credit to a bunch of different lenders. If you're going subprime auto shopping, you're probably going to end up with a lot of inquiries. Now, we talked a little bit about FICO and where to find it, myfico.com. There is another site another consumer scoring agency called Vantage Score. It's a joint effort by the 3 credit bureaus. That's what most consumer sites use. So Credit Hero, Credit Karma, Identity Guard, a lot of tenant screening. I have a rental right now. I've got a bunch of applicants there. I'm going to look at their credit reports. It's going to be a Vantage score. It's not going to be a FICO score. This is, again, a joint effort by the 3 credit bureaus to take a bite out of the competition, which is FICO. You can get your Vantage score right now. For the most part, you can't use mortgage loans with a Vantage score. There's some information that may change down the road, but mortgage lending is almost exclusively done by FICO scores at this point in time. One of the big things with Vantage Score is they do not penalize for paid accounts. So I do have a lot of clients that are 610 FICO and 740 Vantage. Again, I'll touch about that on a little bit. Credit inquiries are often a very big sticking point for people. They're scared to have someone pull their credit. Again, most lenders can do soft pulls now. A hard pull, you're applying for funds. You've done a credit application. Again, there might be a temporary impact. They do stay visible for 2 years. So you should always ask your lender, can you do a soft pull up front? But no lender is going to issue a pre-approval without a hard pull. Soft pull again is just a consumer check. It can now come with FICO scores. It didn't used to, but there's no negative impact to your credit score for a soft pull. And if you have somewhat of an extended credit history, the longer you've had your credit lines open, the less impact a hard pull has to your credit score. If all you have is a 6-month-old credit card, you might see a 10-point hit for a hard pull, but you're going to get those points back very quickly. I liken them to paper cuts. Okay. Now, I do talk very fast, but there's just information I'm just dying to get in your hands, okay? Medical debt, 62% of medical debt, or 62% of bankruptcies are originated by medical debt. 35% of credit reports have collections. That's okay. Let's talk about what we do if we have these collections, all right? There's been some legislative changes that have impacted how medical debt can report to your credit report. In July of 2022, it was mandated that paid medical collections were no longer allowed to stay on a credit report. Right now, paid medical collections or paid collections of any type on FICO impact you just like any other type of collection, okay? Shortly after that, in April 11th, 2023, they made a secondary change that said, and this is for FICO scoring, that no medical debt under 500 can show up on the credit report. So if someone's calling you for a medical debt that's under 500, it's up to you if you pay it. It's not on your credit score. It's not going to improve your credit score. I'm not telling you not to pay it. Everyone has an obligation to pay their debts, but medical debt under 500 can't show up. Vantage Score is a little bit different. They're a little more forgiving. They ignore both paid collections and unpaid medical collections in their entirety. So someone that has a lot of medical debt or a lot of paid collections, their Vantage Score is going to be much, much higher than their FICO score. That's why it's really important not to trust the scores solely that you see on Credit Karma, because that's not what most traditional lending is using. Now let's look at some actual statistical information. So 80% of credit reports contain errors. Now these can be duplications, these can be incomplete trade lines, inaccurate balances or credit limits, merged files like junior-senior files where you got junior's files showing up on senior. Someone else with a similar name. Your name's Bob Johnson, and there's another Bob Johnson in your neighborhood. He's got collections. You and your siblings shared a residence at one point. Your names are very similar, and you were twins. So your Social Security is one number apart. So we see a lot of errors. Late payments after accounts are paid off. That's a big one. Right now we've got Credit Acceptance Corp and Auto Lender that when a car is charged off, they never close it. They just do rolling 120-day lates. So we see a lot of these errors. As I stated on a previous slide, 35% of credit reports contain collections. The national credit card debt is skyrocketing right now. 1.4 trillion in national credit card debt. There's a lot of credit card vendors that are offering zero interest, zero balance transfer cards. So you could have 18 to 22 to 24 months to pay off your debt with zero interest and get some reprieve, but your credit score's got to be there. Typically 680 is where they want to see to get some of these zero interest, zero balance transfer cards. Now, what about automotive refinance? Okay, this is a little bit of a messy slide. Some of these rates aren't achievable anymore, but a $30,000 new auto loan at a 72-month term with a rate of 18.99%, which is probably lower than my average client. That $30,000 car loan is going to pay $24,000 in interest. At the time I made that part of the slide, premium credit would have got you 2.9%, and that person would have paid $2,700. So there's a $20,000 difference. I've got a client right now that has 2 car loans and a boat loan. And between those 3 loans, they're going to pay $180,000 in interest. Improving your credit score allows you to maintain some of your liquidity, invest it in other areas. Getting your credit score up is the #1 investment you can make. If you're in one of these high interest rate loans, let's get your credit score up, get it refinanced, get your loans refinanced. Now, how do we do that? We do that through things like pay for delete letters. Okay, let me see if I can zoom in on this. that was not what I want to do. You know, display settings, swap presenter view. There we go. What we can do is negotiate with a collection agency to agree to delete a collection and a contingency for payment or settlement. So what these examples are, I've got lots on my Instagram and I've got lots on my Facebook, or me working on your behalf to negotiate with a collection agency, because not all collection agencies delete their collections. What you don't want to do is you don't want to pay an old collection and have it updated as a paid account, because that update was called the data last activity. I have absolutely seen scores drop 100 points for people paying the wrong accounts. If you're going to fix your credit, let's reserve your money and use it the best way possible to get the greatest return. Now, so outside of your mortgage lender and outside of me, where can you go to get some information about credit? Well, one of the best places is MyFICO's website. It has an education tab. You see it here in the corner, and there's a ton of tabs you can click into. FICO is going to give you a lot of information about how their algorithm works. I love that site. I also have a YouTube page. I've got a ton of great 1 to 4 minute videos that go into many different topics on credit scores. So I'm going to keep rolling. A couple of things I want everyone to know. There is a law called the FDCPA, Fair Debt Collection Practice Act. This says what a creditor can do if they're trying to seek you out. You know, what are the hours they can call you? What are the things they can say? How many times a day can they call you? A lot of collection agencies violate these FDCPAs, and they can be penalized up to $10,000 if they're violating the FDCPA on you. And skip that just in the effort of time. So what does debt settlement look like? This is a larger debt settlement file. We've got $29,000 settled for $17,500. We've got $16,000 settled for $66,000. We've got $12,000 settled for $18,233. It's not uncommon to get 10% on some of these settlements, especially repos. If you have repos, we get unbelievable settlement options on repos. We can settle judgments. Here's a judgment that we settled. And on the left, here's a home equity line. This was, I'm going to try one more time to zoom in. Oh, that's how I can zoom in. This was a $147,000 HELOC that was charged off. We were actually able to settle it for $59,000, saving the client $88,000. So I'm right here within my window. I'm going to look at the chat if anyone has questions. I don't know if you're able to type them. I do have a much longer presentation if anyone ever wants to see it that goes into a higher level stuff. But our goal here is to get you not just in a loan, but get you the best interest rate, get you a lower down payment, increase your loan ceiling, get a number that it's the maximum number that Origin Point can provide you so that you have more inventory to look at. And that's what we're here to do.
Yeah. And just get you into something that you feel comfortable with too, right? I think you and I talked about, Devin, right, that people have more debt than they've ever had in the history of the world, right? And
Yes.
interest rates are high on credit cards and everything. So Devin is really a great resource to reach out to if you feel stuck, if you just want some advice. He has a website and social media platform that has a lot of really great resources. So definitely give him a follow and we'll get his information out to everybody. And again, this will be on social media and we will send an email out with some information for Devin. But he is such a great resource and I really very much appreciate your partnership over the years, how much help you've given our clients, and just for you being here today with us.
Thank you.
So,
I'd like to add one more thing. I've been doing this 19 years, as I said, and one of the things that drives me crazy, I would say less than 10% of mortgage lenders take the time to work with a client to get them in a position where they can purchase. And I would say even less of that when we look at actual banks. So if you're thinking about going to the bank you bank at to get a mortgage loan, they're just going to deny you. Okay, they're not. There's a lot of red tape. They're usually not allowed to refer to third parties. And most mortgage lenders, when they get someone who's unapproved, they just say you're unapproved. They don't take the time to get you to a helpful resource or give you advice and work with you, whether it's 3, 6, 9, 12 months, whatever it is. One of the things Joanne's so good about is making sure that her team sticks with you. They're your long-term partner to make sure you get in a position where you can purchase.
Yes, thank you. And that's part of what this partnership is all about. So thank you again, Devin, for joining us today. Thank you, audience, for being here. And we will get this information out to you. But everyone have a great rest of your day. All right.
Thank you.
Thanks. Bye-bye.